Somewhere outside Amarillo, Texas, there's a piece of farmland that was supposed to host one of the largest data center campuses on the planet. 17 gigawatts of computing power, backed by a former U.S. Energy Secretary, named informally after the sitting President of the United States. It raised close to $2 billion before it had a single confirmed customer. 18 months later, the CEO was gone, removed. The company later said, for cause. The company's market value had dropped by more than 80%, and the client everyone assumed had signed on had already walked away. This video is about why that keeps happening, not just in Texas, across the country, in a year when the money being spent on AI infrastructure is larger than almost any capital deployment in history. We're going to look at it through 4 forces: money, power, parts, and people. And there's a fifth idea sitting underneath all of them, one that explains why this keeps happening no matter how much cash gets committed. We'll get to it. Welcome to the first episode of The Fifth Principle. Here's the contradiction this channel exists to investigate. In 2026, 4 companies, Alphabet, Amazon, Meta, and Microsoft, are projected to spend a combined $650 billion on AI infrastructure. That figure is confirmed across multiple financial and trade outlets, and yet, according to data from the research firm Sightline Climate reported by Bloomberg, of the roughly 12 to 16 gigawatts of new U.S. data center capacity that was supposed to come online this year, only about 5 gigawatts, call it a third, is actually under active construction. Call that gap the paper-to-power gap, the distance between what's been announced in a press release and what's actually generating a single watt of usable compute. Every story in this video is really a story about that gap and what keeps widening it. An important caveat before we go further, because we're not interested in the exaggerated version of this story, analysts at the research firm SemiAnalysis have pushed back on the more viral claim that half of all data centers are canceled. Their argument is that datasets like Sightline's lean heavily on large, publicly announced megaprojects, exactly the kind most likely to slip, while plenty of smaller, experienced developer projects are moving on schedule and simply don't make headlines. Even accounting for that though, Sightline's own range 30 to 50% of the 2026 pipeline facing delay or cancellation is the estimate most analysts are currently working from. So let's take this apart properly. 4 forces, starting with the one that's easiest to move and the one everyone assumes is the whole story. If you're the kind of person who wants to understand what's actually happening underneath the headlines, not just the hype, a like and a subscribe is what keeps this channel able to keep digging into stories like Fermi's. Genuinely appreciated. Back to the boardroom. Money is the principle everyone talks about because it's the biggest number and the easiest one to headline. It's also, on its own, the least useful for predicting what actually gets built because money can move in an afternoon. A wire transfer, a bond issuance, a term sheet. None of that requires anything physical to exist yet. Here's the scale of it. OpenAI has committed roughly $1.4 trillion over 8 years toward data center capacity, including a partnership with NVIDIA for 10 gigawatts of compute. At the time of that commitment, the company's annual revenue was reported at around $13 billion. Call that ratio the hype-to-revenue ratio, what a company has committed to spend versus what it currently earns. It's not inherently damning. Young, fast-growing companies routinely spend ahead of revenue. But a 100-to-1 ratio is the kind of number that makes the "is this a bubble" question unavoidable rather than paranoid. The debt side tells a similar story. Meta raised $25 billion in fresh debt this year, after raising roughly $30 billion in late 2025. Amazon reportedly moved to raise $25 billion of its own, while reportedly telling underwriters it did not intend to seek additional debt financing for the rest of 2026. There's also a demand-side wrinkle worth sitting with. A National Bureau of Economic Research working paper published in February 2026 found that roughly 90% of firms surveyed reported no measurable AI impact on productivity or output, even as executives at those same firms projected meaningful future gains. That doesn't mean AI has no value, but it does mean the revenue case for all this infrastructure is still, in large part, a projection rather than a track record. And even Meta, one of the companies spending the most, has reportedly had internal conversations about its AI investments not progressing the way it had hoped, according to Reuters. The company has also confirmed plans to lease out AI compute capacity it built but hasn't yet used, which investors read as either smart monetization or a quiet admission of overbuilding, depending who you ask. Which brings us back to Amarillo. Fermi America's stock at its October 2025 IPO valued the company at roughly $15 billion before it had signed a single confirmed binding customer. By this spring, that value had fallen to around $3.5 billion. The company is now facing a shareholder class action lawsuit alleging it misrepresented demand for the project after its presumed anchor tenant reportedly canceled its agreement. Fermi has not confirmed who that tenant was. Money got Fermi a NASDAQ listing and a name borrowed from the White House. It did not get them a customer. Keep that distinction in mind, it's going to matter again in a few minutes. If money is the principle that moves fastest, power might be the one that moves slowest, and it's non-negotiable. A server rack is useless without electricity, and increasingly without water for cooling. A single large hyperscale campus can draw as much power as a mid-sized city. In Utah, a proposed 40,000-acre data center campus in Box Elder County, more than twice the footprint of Manhattan, was projected to require roughly 9 gigawatts of power, more than the entire state currently consumes. Following public backlash, the project's backer, investor Kevin O'Leary, agreed to scale the footprint down to roughly 10,000 acres, according to reporting in the American Prospect.
Listen, I'm taking some responsibility. We really screwed it up. We pissed off a lot of people, and that's not the way I do business.
That's the physics tax in action, the cost and time and scope that real-world constraints impose on a plan that looked clean on a spreadsheet. And it isn't isolated to Utah. According to Sightline Climate's outlook, roughly a quarter of the data center projects planned for 2026 have not publicly disclosed how they intend to secure power at all, which tells you the electricity, not the capital, is the open question keeping developers quiet. Utility interconnection queues the waiting line to actually plug a new facility into the grid have stretched dramatically. Projects that once expected to connect within a couple of years are now facing waits of up to 5 years in some regions. Water tells a parallel story. Cooling systems for large facilities can require millions of gallons a day, comparable to a small city's usage, which is precisely why water access has become as contested as electricity access and permitting fights across drought-prone states. Fermi's Amarillo site sits adjacent to a Department of Energy nuclear facility and was designed around a mix of natural gas turbines and eventually 4 next-generation nuclear reactors, the earliest of which isn't expected to be operational until 2032, 6 years from now, according to the company's own published timeline. 17 gigawatts of ambition, and the power to run even the first fraction of it is still years away. That's power. 2 principles down. Here's where the story gets almost absurd. A campus with unlimited capital and an approved grid connection can still be stopped by a piece of equipment that would fit in a garage. Parts, specifically transformers, switchgear, and battery systems, are in critically short supply worldwide. Before 2020, ordering a high-power transformer took roughly 2 to 2.5 years. Today, that lead time can stretch to nearly 5 years. These components represent less than 10% of a data center's total construction cost, and yet a single missing transformer can idle a multi-billion-dollar facility indefinitely. A billion-dollar campus can, in other words, be defeated by the industrial equivalent of a missing extension cord. A large share of this equipment is manufactured in China, and geopolitical tensions and tariffs have made that supply line increasingly unreliable, which means American developers are, in many cases, waiting in the same global queue as everyone else. For parts they can't build fast enough domestically to matter this decade. Then, there's memory. AI servers require enormous amounts of specialized high-bandwidth memory chips, and the world's 3 dominant manufacturers, Samsung, SK Hynix, and Micron, have shifted the overwhelming majority of production capacity toward it. Analysts at IDC estimate AI data centers will consume roughly 70% of the world's memory output in 2026, up from 20 to 30% as recently as 2022. The result, DRAM prices have risen somewhere between 80 and 90% in a single quarter this year, with certain memory chips reportedly up close to 4-fold. Micron executives have said publicly they don't expect meaningful relief before 2028. This is the physics tax compounding. It's not just that parts take longer to arrive, it's that the AI boom is now competing with and inflating prices for the entire global electronics supply chain, including the laptop or phone you might be watching this on. Fermi's own turbine deliveries offer a small-scale version of this same pattern. The company confirmed receiving the first of 6 natural gas turbines ordered from Siemens Energy turbines that were only ever meant to supply about a third of its first gigawatt out of 11 planned. 3 principles down. Watch how they start to connect. The 4th principle is the one the industry has historically underestimated the most. People. The residents, local governments, and utility ratepayers who live next to what gets built, and who increasingly have a say in whether it gets built at all.
It feels like where we thought we moved and are living the dream where we are, it's now turned into a nightmare, to be honest.
This is where we need a specific framework, because backlash alone doesn't explain what's happening. Call it community ROI, a simple comparison between what a host community is offered against what it's asked to absorb. That comparison has not been going well for the industry lately. According to the research firm Data Center Watch, more than 75 proposed data center projects worth roughly $130 billion were blocked or delayed in just the first several months of 2026 alone, matching the total blocked for all of 2025. At least 69 local governments have enacted some form of ban or moratorium as of mid-2026, including a 1-year construction pause in Seattle. A statewide ban nearly passed in Maine, stopped only by a gubernatorial veto. Public sentiment has moved with it. A Quinnipiac poll found roughly 2/3 of Americans oppose new data center construction near their community, and separate polling cited by industry researchers found opposition climbing from around half to as high as 70% within a matter of months. There's also a less comfortable, well-documented development worth including here. Internal Law Enforcement and Fusion Center documents obtained by Wired in The Intercept in 2026 describe monitoring of public criticism of AI and data centers under an anti-tech extremism framework connected to domestic terrorism intelligence work.
The chaotic atmosphere that may result from emergent AI technology in the next 5 years may fuel large-scale protests that devolve into civil unrest and anti-tech violent extremist activity, especially in large urban areas such as New York City. This follows last month's arrest of a 20-year-old man who allegedly threw a Molotov cocktail at the home of OpenAI CEO Sam Altman and also threatened to burn down OpenAI's headquarters.
The reporting and the government's characterization of it differ. Fermi's Amarillo project hasn't faced the kind of organized local opposition seen in Utah or New Jersey. Its site sits on land tied to Texas Tech University, adjacent to an existing federal nuclear facility, which is a very different starting point from a subdivision in New Jersey. But it hasn't needed local opposition to stall. It's managed that on its own. 4 principles down, 1 pattern already emerging. Before we go further, it's worth taking the other side seriously, because a lot of smart, well-informed people genuinely don't think this is a bubble. First, delays don't automatically mean weak demand. If anything, some analysts argue the opposite, that a true demand collapse would look like canceled orders, not just slow-moving construction. Right now, hyperscalers are still raising their spending guidance, not cutting it, which is not the pattern you'd expect if customers were disappearing. Second, the comparison to the dot-com crash may not hold. Federal Reserve Chair Jerome Powell has pointed out that today's highly valued AI companies, unlike many dot-com era firms, actually have earnings. NVIDIA, the company most central to this build-out, trades at a forward price-to-earnings ratio of roughly 22, according to market data reported this year. Third, the half of everything is canceled framing may overstate the case. As mentioned earlier, the datasets driving that headline lean toward large, speculative megaprojects. Smaller, experienced developers may be executing largely on schedule. The failures are simply louder. Fourth, some of the most senior voices in finance argue the opposite risk exists. At Davos in early 2026, BlackRock CEO Larry Fink summarized the conversation with NVIDIA CEO Jensen Huang by suggesting the more useful question might not be whether the world is in an AI bubble, but whether it's investing enough in the underlying infrastructure, energy, and compute to meet demand that's still growing. So what would actually settle this either way? A few things: whether AI-linked revenue growth continues to outpace infrastructure spending growth or falls behind it, whether the paper-to-power gap announced versus actually built capacity narrows over the next 2 years as supply chains catch up, or keeps widening, and whether hyperscalers, who are overwhelmingly self-funding this out of enormous existing cash flow, start showing real strain versus smaller, debt-heavy developers like Fermi, who don't have that cushion and may simply be the first ones to hit a wall that the giants never reach. That distinction matters more than most coverage admits. A handful of speculative players struggling is very different from an entire sector's fundamentals breaking down. So let's close the loop on Amarillo, because by now, you can see all four principles in one place. Money got Fermi a NASDAQ listing worth $15 billion before it had a paying customer. Power meant its most ambitious asset, nuclear generation, won't come online until the next decade, even on the company's own optimistic timeline. Parts meant its very first phase depended on turbines arriving from a single overseas supplier, on a schedule the company didn't fully control. And people in this case, not angry neighbors, but skeptical shareholders and a departed CEO fighting to get back in, proved just as capable of stalling the project as any protest could have. 4 principles, 1 project. And every one of them moved at a different speed than the press release promised. And that brings us to the 5th principle. Constraint. Here it is, stated plainly. Infrastructure moves at the speed of its slowest physical dependency, not at the speed of investment, promises, or hype. Money can move in an afternoon. A press release can move in minutes. But a transformer takes years to manufacture. A grid interconnection takes years to approve. A skeptical community takes years to convince, if it can be convinced at all. And a nuclear reactor, on the most optimistic corporate timeline available, takes until the next decade. The overall pace of this entire industry, not any one company, all of it is set by whichever of these 4 principles is slowest at a given place in time, not by how many zeros are on the spending announcement. A company can raise $15 billion in an afternoon and still be waiting on a single transformer 3 years later. That's not a contradiction. Once you see the 5th principle, it's the default outcome. This is also why the bubble or not question, on its own, is a little too simple. The financial bubble question and the physical bottleneck question are related, but they're not the same question, and they can resolve differently. Demand could turn out to be real, and the industry could still be years behind its own promises, because money was never the constraint holding it back in the first place. So instead of asking, is this a bubble, which nobody can answer with certainty right now, here are 5 measurable things worth tracking over the next 12 to 24 months. 1. The paper-to-power gap. Is the share of announced capacity actually under construction narrowing, or staying stuck around that 1/3 mark? 2. Signed, binding customer contracts, not letters of intent, not rumored tenants, but confirmed anchor customers for major new campuses, including whatever Fermi manages to land next. 3. Equipment lead times. If transformer and turbine delivery windows start shrinking back toward pre-2020 norms, that's supply catching up. If they keep stretching, the physics tax is still rising. 4. Credit market behavior, specifically whether yields and spreads on data center linked debt stay stable or start widening, which would signal investors pricing in more risk than official credit ratings currently reflect. 5. The pace of local cancellations and moratoriums plateauing would suggest communities and developers are finding workable middle ground. Accelerating would suggest the community ROI equation is still unresolved. Here's the honest dividing line. If the paper-to-power gap narrows, lead times fall, and cancellations plateau over the next 2 years, this looks like ordinary, if unusually large infrastructure growing pains. If spending keeps climbing while cancellations also keep climbing, contracts stay scarce, and credit spreads widen. That's a much stronger signal of real capital misallocation, not just a rough patch. Every one of these 4 principles can move independently. Money can arrive in a single wire transfer. Power, parts, and people generally can't be rushed at any price. That's the entire point of the 5th principle. So here's the question worth sitting with. More than is this a bubble? Of the 4 principles, which one do you think is most likely to break first in your part of the country? And which one do you think won't bend at all, no matter how much capital shows up? Leave your answer below. I will be tracking all 5 indicators. So let's see who was right.